Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Franklin Resources, also known as Franklin Templeton Investments. I have already analyzed another investment bank with T. Rowe Price. So if you're interested in a T. Rowe Price analysis as well, I have linked the video in the info card. Let's begin with looking at the revenue. Last, they generated a revenue of $8.4 billion. They have a market capitalization of $13 billion. And as the name already suggests, they are operating in the financial services sector. The income of Franklin Resources is generated through management fees. 78% of the revenue is made through investment management fees. 19% is made through sales and distribution fees, and the last 3% is made through shareholder servicing fees. Regarding the geographically diversification of the company, it is informed that 78% of the revenue is made in the US, 18% is made in Luxembourg, 5% is made in Asia Pacific, 4% in the Americas, and the last 3% in Europe, Middle East and Africa. If you want to know more about the revenue, you can check out the annual report of Franklin Resources, which I have linked down below. Enough about the introduction. Let's find out if Franklin Resources is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Franklin Resources is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 3.53%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Franklin Resources is 53%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Franklin Resources is 53%. This value is deep inside the red section of my rating scale. Therefore, I'll add 5% to the margin of safety. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 20 cents were paid, and in 2022, $1.70 is expected. It is noteworthy that the company has paid special dividend 5 times in this time period. In 2010, 12, 13, 15 and 18. Franklin Resources has paid and increased the dividend for 31 consecutive years, which makes them a solid dividend aristocrat. In the last 5 years, the average dividend growth without the special dividend was 7.9%. A dividend growth of 7.9% is a stable matrix. Therefore, I'll subtract 5% from the margin of safety for the dividend growth. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. the free cash flow from Franklin Resources has decreased from $2.1 billion in 2018 to $1.2 billion in 2021. The cash dividend was $0.6 billion in all years. Well, at least in the graph. In reality, the cash dividend payout is slightly increasing, but I don't want to bother you with the decimals. And you might wonder why the free cash flow in 2019 is so low. The explanation is actually quite short. In 2019, Franklin Resources used the cash flow to acquire Benefit Street Partners, which is an alternative credit investment group. For this reason, I do not take this year into account when I calculate the payout ratio. Thereby, the payout ratio becomes 45%. This value is in the middle of my weighting scale. Therefore, the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $2.4 billion and have $4.4 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $2.8 billion. But since the company has more available cash than debt, the debt to equity ratio becomes zero automatically. The debt can't be negative, therefore the numerator becomes zero, and the fraction becomes zero if the numerator is zero. But enough about the mathematics. The debt to equity ratio tells us that the company could pay off the whole debt at any time if they wanted to. This is of course a sensational value for this matrix. I'll subtract 5% from marginal safety for this value. The last thing I'm looking at is the growth of the company. The revenue has increased from $6.4 billion in 2017 to $8.4 billion in 2021. This gives an average growth of 7.2%. In the same period of time, the EBIT increased from $2.3 billion to $2.4 billion, which gives an average growth of 1.3%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 35.4% and in 2021 decreased to 28.2%. Since the revenue increases at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. In this case, it decreases with 5.5% in average each year. An EBIT growth of 1.3% is in the yellow section of our weighting scale, which gives no further adjustment. But an average margin decreasement of 5.5% gives plus 10% to the marginal safety. Since every matrix for my analysis has now been collected, it is time to adjust the marginal safety. Plus 5% for the relative standard deviation, minus 5% for the dividend growth, minus 5% for the debt, and plus 10% for the margin growth. The new marginal safety is therefore 30%. This leads to a desired dividend yield of 4.59%. By a current dividend of $1.70, I should therefore don't pay more than $25 for the stock. By ignoring the marginal safety, the fair price of the stock is determined, which for Franklin Resources is $33. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the marginal safety to the historical yield curve. This then gives a new curve which always lies 30% over the historical yield curve. As seen in the graph, the historical yield is under the yield curve, but the marginal safety is over the yield curve. Therefore, I consider the stock at its fair value, but it is not yet in a region where I would buy it. Finally, I consider the stock at its fair value when the price is $33, I would buy the stock at $25, and the stock price is currently at $26. If you did like the stock analysis, please consider to give the video a like, let me know in the comments which stock you would like to see next, and subscribe to my channel for more content.